I want to talk about the strength of the U.S. economy and whether or not the recent data that are coming out give any evidence at all of concern in terms of something we call stagflation, which is sort of the simultaneous weakness in the labor market, but growing inflation. That's sort of what I kind of want to key in on. And part of the reason for that is that the Fed has a dual mandate. Their dual mandate is to have stable employment, stable inflation, or strong employment growth and stable inflation. And sometimes those come in conflict with each other. So when you have very high inflation rates, to get that down, one of the things you need to do is decrease demand, overall demand in an overheated economy, but that can have an impact on the labor market. But in a kind of a rare event, you sometimes get a situation where the labor market starts growing weaker, but yet we have evidence of growing inflation. And I'm going to show you some things that will suggest that that may be something to look out for. But in terms of the strength of the economy, one of the things that has been relatively strong is the growth rate of GDP. These are sort of the change in the gross domestic product, the value of goods and services in the economy over a quarter. But then this is expressed at an annual rate. But in the very last, this was revised, that red 0.7, it was actually much stronger when it first came out, but the second preliminary release has shown some weakness for the first quarter of this year. So that's a little bit concerning in terms of a decrease in the rate of growth of GDP. What you have in black here is the coincident index. This is a set of indicators that tend to turn when the economy turns. So if we go into a recession, they will, in a coincident way, start to fall back down. Or if we go into recovery, go back up. And you can see they're still rising, although there's some evidence to suggest that they're rising at a slightly lower rate. The blue is the leading economic index. That tends to turn down well before a recession. And you can see there, between 2007 and 2009, what you can see is that the leading index actually declined well before the recession began. Okay? So the fact that it's declining here does not mean we're in a recession, but it's something that obviously we want to look out for. In terms of what is weak, what I'm going to go through are some of the major indicators that are part of that leading index that are contributing to this notion of weakness. And consumer confidence has been falling. And you can see that back in 2022, it kind of hit a little bit of a local peak after the pandemic. And it has been falling somewhat steadily ever since. Another area that is somewhat problematic, very problematic in the economy, is housing. I could have given you probably 45 charts on housing, but this is representative of the fact that the housing market has reacted, especially to the increase in interest rates, where the Fed was fighting inflation over the last couple of years. This is building permits for new private housing units have been falling pretty steadily, but you've got a lot of other indicators that show kind of the same thing. This is a coincident indicator. It's called payroll employment, and it's about 50% of the weight of the index for that coincident index that I was talking about. And this is one of the areas that is of concern, the weakness that is going on in the labor market. And what you have, for example, it was really kind of an unusual month, but in January, payroll employment increased by 126,000, but then followed by the latest report of a negative 92. But if you take a longer look, basically what we're doing here in this chart is looking at the change in payroll employment from December to December of every year over an extended period of time. And you can see the last year was relatively weak at 116, that the sort of change over the year. And with that, you had a very low level of average jobs per month. And that's part of the concern. The other part of the concern is the red here versus the blue in terms of the industries that are represented. In blue, we have the industries that are growing strongly, and what we're really looking at is the distance between February 25 and February 26. And then in red, the ones that are going negative. And what you'll notice from this is that we have a concentration of growth. We don't have robust growth across all the different industries in the US. It's really concentrated in healthcare, social assistance, somewhat in leisure, and then a little bit in construction, but that varies quite a bit. But it's mainly in healthcare and social assistance. And without that kind of robust growth across the economy, it is suggestive of the fact that things are a little bit weaker in terms of the labor market. The other aspect is a couple of years ago, all we could talk about was shortages. Firms saying they could not find workers. What we have is an opposite narrative now in terms of job openings have fallen relative to hires, and they've gotten a lot closer. That gap that you see, that big gap between red and blue in 2022, when all we could talk about was shortages, is relatively gone at this point. And quits themselves also, remember the conversation that we've had about the quit economy, people that would get hired and then a week later you couldn't find them because they found another job for higher pay? That's also going away. We have quits have really lowered in the economy. But the one area that has a bigger gap is within healthcare and social assistance. That industry that I just showed you had very relatively strong growth between job openings and hires. So that's sort of the weakness of the labor market. I want to talk next about what's going on with inflation and sort of give you a couple different looks at it in terms of where I see some areas of concern. So here for in this particular chart, what we have is what's called the all items CPI-U. And it's a 12-month % change. And what I've noted here is that I have a Fed target of 2.5%. That's not quite true. The Fed's target is not on the CPI. It's on the Personal Consumption Expenditure Index. A slightly different concept, but the CPI, the Consumer Price Index, and the PCE differ in a somewhat regular way, about half a point. So what I did here is I just measured it at 2.5%. And basically what we have is that in recent months, we have gone below that, quote, 2.5 target. So that's kind of good news. And you can see that we declined quite a bit from 22, where we hit a 9.2%, 9.1%. But why am I concerned? Well, one of the concerns is that housing market I talked about. What we're looking at here is the percentage contribution of different sectors to what's going on with inflation. And the rent of shelter has an outside contribution in terms of affecting what's going on. And another one, if you take a look at the light blue, what I'm looking at here is, in light blue, the price index, the inflation rate for services versus orange in commodities. And what you can see is basically inflation is being heavily affected by what's going on in inflation in services. That's a different story than we had a couple years ago with the supply chain, all those disruptions globally with the pandemic. There was a lot of high goods inflation. It's now more of a services story that's going on. And speaking of services, if you take a look, this is the Producer Price Index. So this measures the transactions that are received by producers for the goods that they sell, that they make and sell. So think of that in terms of they make some goods or they provide a service. What are the transactions they receive for that particular enterprise? And what we have are things like final demand, and then final demand services, final demand goods. This is just basically taking all the consumer products that are out there and looking at the transactions received, whether it be a good or a service. Normally we don't talk about the PPI, so I'm being a little bit more expansive. But if you take then a look at final demand trade services, that's what we call a margin index. So think of a grocery store providing a service to us. They have inputs that they pay for, and then they get all the transactions they receive over a particular period of time for the goods that are sold to the public. That difference is called a margin. And one of the concerns is what's happening to margins in our economy, say for example with tariffs, and just what's going on in general. Well, if one of the things that firms can do is eat the margins, if you will. In other words, lower their margins to stay competitive. Or, depending on the market, depending on their cost pressures, they could pass on those margins. But if they're passing on the margins, that could lead to higher inflation in the future. So if you look at the services, in January we had a remarkable increase in the final demand trade services index for PPI. And I think that's really something to look out for because services are really the dominant part of the inflation story. And then finally, this is something I just like to look at. There's 70 expenditure items in the CPI. They collect 80,000 prices a month, but they group them. And when they group them into these 70 categories, one of the things you can say is, well, what percent of those items have an inflation rate, 12-month inflation rate, greater than some X percent? So again, I'm using that 2.5. And you can see in June of 22, we were at almost 92%. It has come way down to the 30s, and that 30s is somewhat not that far above that normal that we had before the pandemic. We're back up over 50, which to me is suggestive that there's a little bit of creeping, more widespread inflation going on. All right. And then finally, I just always like to show this chart. We just keep updating it. It's not technically pure in terms of a price index, but it's looking at average prices in the month. And if you just take a look at milk, in February 20, it was $3.20. The max price it hit, and this is the average price series from BLS, was $4.22 in November. And it has come down, like inflation has come down. It's come down all the way to $4.03. This is why people are upset. And so there's this notion not only that there's some creeping inflation going on, back up, but also the prices themselves, and it obviously has to be relative to your income, but incomes grow slowly, but the prices themselves are still relatively high for a lot of the items that people buy.